In this module, we're going to discuss a specific type of long-term liability. Recall that long-term liabilities arise generally from major expenditures. There's some type of project that we need to finance, so we go out and raise the funds through a long-term liability. It could be maybe you're purchasing a planned asset, you're trying to acquire another company, and it'll generally involve a large dollar amount. That's why you're having to go out and raise these funds externally, because you could hopefully finance a lot of expansion through internal fund generation of just positive cash flows. You know, if your operating income is generating positive cash flows and you can generate enough cash, you shouldn't hopefully have to go out and borrow money that often. But it could be there's a project that comes along and you need to go borrow some money to try to help finance it. It can be regarded as an alternative to owner's equity. So we talked about this in the previous module, that companies have a choice often to either go and externally generate the funds or raise the funds, or try to ask the owners to kick in money to raise the funds. The huge benefit of issuing debt when it comes to raising funds is that interest is tax deductible, whereas dividend payments are not. You know, dividends have the double taxation problem. So firms would a lot of times prefer to finance stuff through debt because they can deduct the cost of that debt for tax purposes. The other major benefit is the debt holders do not get to share in the abnormal profits of the project you're investing in. So if you've got a great idea and you think it's going to generate abnormal returns, it's going to be able to make you rich and famous, you know, you don't want to share the wealth that you're creating with that idea with other people. So you'd prefer to go out and borrow and not necessarily allow other people in on the equity interest. So for firms, a lot of times it's beneficial to go to the debt market before you go to the equity market. The way debt works is it eventually is going to mature. We talked about this in the previous module. For most firms, though, a lot of times they end up refinancing the long-term debt. So if you've got a 10-year bond out there that's coming due in the next year, often firms will roll that over into a new 10-year bond. So they'll go issue another bond to essentially satisfy the debts of the one they've just that just matured. So you'll see that happen often. So let's walk through an example of an installment note payable. So this is a note payable that's requiring a series of payments to pay the note off. And this is an example of how a mortgage would work. So let's say you purchase real estate or a type of equipment that involves a series of payments. Could be due monthly, could be due quarterly, semi-annually, or at any interval specified by the contract. For a mortgage payment, it's normally monthly. And it is generally comprised of interest and principal, but it could be an interest-only loan. So some loans out there are really you're only paying interest, you're not making any dent in the principal. And what you'll see is you'll normally see firms use an amortization table to determine kind of what component of the payment was interest, what component of the payment was principal, because we know that principal reductions on a loan, and you think about it in terms of cash flows, right? If you're paying back a loan, cash is going out. So what we're trying to determine is how much of that cash outflow is going to go to a financing activity, the retiring of a loan or paying off of a loan, and how much of it is going to the interest component, which is an operating activity. So it's important to be able to distinguish one lump sum cash flow between its operating and investing cash flows. So an example of how you'd use the amortization table is, let's assume that on January 1st, 2012, Sunny Company purchases equipment at a total cost of $20,000 from Equipment Company. So they went out and bought $20,000 worth of equipment, but the way they financed this was by issuing a note payable. So they didn't pay any cash out of pocket, they went out and borrowed the $20,000. And the way the note was structured is that it's going to have to be paid off within 15 months, and those monthly installments are $1,442.50. And those payments begin on February 1st at an annual interest rate of 12%. So the way this amortization schedule is going to work is we're going to try to come up with a way to systematically reduce this note from $20,000, the beginning value, to zero, because we want to pay this thing off in 15 months. We want to make sure that the The amortization table is factoring in a 12% interest rate because that's what the charge is. And we want to try to distinguish that 1442, that payment that we have to make. We want to try to see if we can split it into what part of its principal and what part of its interest. And that's going to change over time. Because as that $20,000 liability starts getting paid off, the interest associated with that liability is going to go down. So here's what it would look like. Here's all 15 payments. So you start off with a beginning balance, if you look at the top right part of the screen, of $20,000. And if you look at the bottom right part of the screen, it goes to zero after the 15 payments, which is what we're trying to do, pay off this note in 15 payments. And then you've got your monthly payment of $1442.50 showing up in the second column of this table. Now what we're trying to figure out is how much of that $1442 is interest and how much of that $1442 represents principal reduction. The way to determine how much is interest is you look at the beginning balance, the $20,000 beginning balance, and you multiply that by rate and by time, just like you do any interest calculation, and that'll give you $200. The $20,000 times a 12% interest rate times 1 over 12, because we're only talking about 1 month's worth of interest, equals $200 worth of interest. So that $1442 that you pay on February 1st, 200 of it is going to cover interest, and only $1243 actually goes to reduce principal. Okay, so once again, you're starting with a $20,000 balance, and after the first payment, you're making a $1442 payment, so you'd almost like to think that you don't owe $20,000 anymore, and what you owe is $20,000 minus $1442. But if you do that, you're ignoring the fact that there was interest charged on this loan. They didn't give you an interest-free loan. So if you take your $20,000 and you take away the $1243, which is how much of that $1442 actually went to principal, then you can revise your principal balance on the loan to $18,758, which is the far right column, second row. So after that first payment, you've reduced the principal balance on the loan to $18,758. Now if we go to the next year, or the next month, I'm sorry, when you go to March 1st, you're going to make the same monthly payment, the same $1442.50, but notice the interest component, the amount of interest that you're paying has gone down. Now it's $188. The reason is because the principal went down. You're no longer being charged interest on $20,000, you're being charged interest on $18,758. So if you take $18,758 and you multiply that by 12%, and you multiply that by 1 over 12, you're going to get $188. So that's the way a mortgage, so the difference, the $1,255 is going to go to reduce the principal. And that's exactly the way mortgages work for a house. If you go buy a house, in the beginning, a significant amount of your payment is made up of interest. It's comprised of really just interest. So you're not making much of a dent in the principal of your loan. So you can get a 30-year mortgage. Say you buy a house and you have to finance $300,000. And you get a 30-year mortgage. After 10 years, you'd like to think you've paid off 1/3 of the mortgage because you've gone through 1/3 of the term of the loan. It's a 30-year mortgage. You've made your payments for 10 years. So you'd like to think that remaining mortgage amount still owed to the bank would be all the way down to $200,000, that you would have paid off 1/3 of that $300,000 loan. But unfortunately, that's not the way it works. And it's because in those first 10 years, a significant amount of your payment is going to interest, and it's not really reducing the principal proportionally. Now, if you notice in this example here, in the beginning, the very first payment had $200 worth of interest. When you get down to the bottom, the last monthly payment, only $14 is interest. And so likewise, the principal that you're reducing with the first payment is only $1,243. Even though you're making a $1,442 payment, only $1,243 is going to principal. By the end of the 15 months on that last payment, almost all of it goes to principal, $1,428. So that's, again, going back to the mortgage example, in the final 10 years of a 30-year mortgage, you end up paying off more than $100,000 worth of the loan. Because proportionally you're not paying as much in interest. Okay. So a couple things that I want to kind of point out again. when it comes to that amortization table, if we go back to it for a second, the monthly amounts, if you sum up those 15 monthly amounts, it's going to exceed $20,000, and that's because there's an interest component. So that's going to be a bullet point on the next slide, but I want to kind of point it out now so when we get to it we can readdress it. And that the balance from 20,000 to zero is not going down in a linear fashion. It goes down a little bit in the beginning and a lot at the end because of that interest component eating up a chunk of the payment in the beginning and not so much at the end. Okay, so even though the monthly amount's the same, the interest plus principal amount comprises the monthly payment amount. And like we talked about, the interest amount is based off the balance from the previous period and therefore is going to decrease each period with the balance. So in the beginning you're going to pay a lot in interest. At the end you're not paying so much in interest because the principal amount that the interest is calculated on is going down over time. The principal portion of the payment is going to increase each period, which is kind of nice. You know, when you get to the end of the mortgage, more of your payments actually going to principal. And like I said, when you add up all those payments, it exceeds $20,000. But that's just because you didn't get a free loan. You know, you had to actually pay interest on it. In the balance sheet, when you go to prepare your balance sheet, the portion of the debt classified as current is going to be the portion of the debt scheduled to be repaid within the next 12 months. And then the remainder will be classified as a long-term liability. So again, like I talked about before, if you think about a mortgage, if you got a 30-year mortgage, the next year's worth of mortgage payments, you know, that comprise part of your overall mortgage that you still owe. You know, if you ever look at your mortgage statement, it gives you a payoff balance. So like if you wanted to pay off your mortgage today, here's how much you owe. Well, some part of that is going to be paid in the next year through your mortgage payments. That's the current liability. Everything else is a long-term liability.